Welcome to The Deep End by On Deck, a podcast where visionary builders, creators, and thinkers discuss world-changing stories and ideas. I'm your host, Marshall Kosloff.
And ultimately, I think that people are just, the reason that they're not getting in the game is similar to the founder stuff, right? Why aren't founders actually sort of getting off the fence and like building companies? Well, oftentimes it's like, well, I don't know anybody to start a company with. Well, On Deck solved that, right? We have cohorts of people that are looking to start companies, and a lot of them are looking to start a company and they might want to start it with you, right? They're like, well, I don't really feel like I have the right way to like discover the idea. Well, On Deck creates like a cohort around, making it so that people can go through the idea maze together. They can sort of like work on different ideas, that sort of thing. And I think the same thing is true for angel investors. It's like, well, I don't really meet that many founders in my day-to-day life. So it's like, how could I really get more involved in angel investing? Well, the way you do that is by being involved in a community of other angels, right? And other angels will be introducing you to the founders that they're investing in or the companies that they hear about, right? And you're going to be doing that for them. And not only that, but you might say to yourself, well, how do I know if I should invest in this company? Well, you're going to talk through that with other angels as well.
This season of The Deep End is focused on the present economic reality of late stage 2022. The climate for startups has changed, and founders and the companies themselves are changing their tactics. We'll be talking to people in the trenches, founders navigating their way forward in shifting macro conditions, and the visionaries providing new ideas and strategies that give us cause for optimism. Joining me in The Deep End is Julian Weisser, co-founder of On Deck, partner at our Founders and Angels program, and investor at Other Ventures. Julian is a prolific startup investor and has backed over 100 companies, ranging from asteroid mining to dog longevity and decentralized museums. He's often one of the first angels that founders seek out for guidance on how to construct their fundraise. Angel investors play a critical role in the startup ecosystem by providing the first financial injections into nascent ideas that could eventually go on to change the world. Julian coined the phrase momentum capital, describe how investors have the ability to help founders get the round moving and eventually help them close a strong lead. In this conversation, we discuss momentum capital, how startup investing has changed since the pandemic, why early stage investing is a social sport, and how communities like On Deck Angels help angel investors develop their investing muscles. Julian Weisser, welcome to The Deep End.
Hey, it's great to be here.
It's great to chat with you again. Longtime listeners will note that you appeared on our 2021 predictions episode back at the end of last year. You should definitely go check that out after you finish this conversation. So Julian, I'd love to hear about you, like what your current role at On Deck is, and then get into the actual topic of conversation today, which is angel investing, your actual background there that you've brought to the table here.
Sure. So I'll just be brief and then we can go in any direction that you'd like. I've done a lot of things at On Deck over the years. I was our first head of product, built out our admissions team, led recruiting, helped actually launch this podcast. So it's really coming full circle to be here. And let's see. I mean, right now I'm working on really two things, working with our founders in the On Deck Founder Fellowship, and then working with angel investors, people who are looking to essentially jump into the deep end and really start deploying more capital and investing in more founders, and not just investing, but supporting them, which is such an important role of angel investors in the startup ecosystem.
And you've been angel investing for way pre the COVID era, correct?
Yeah, I think probably about 4 years, something like that.
So as I'm hearing this, I'm hearing different eras of angel investing. So the 2018, 2019 period, the immediate COVID, holy crap, everything is shut down period. And now just whatever you would describe this current moment as. Can you break those three into categories, A, from your mentality as an angel investor perspective, but also just like what were the conditions at an almost like macro level that were shaping your thinking and maybe even the thinking of the actual like founders you were investing in?
Sure. So I think it probably helps to give a little context about my angel investing and sort of how it's developed. And I could do that through the lens of those three different periods. I really got started because of On Deck and seeing so many great people at these happy hours that we were hosting before we turned On Deck into a company, starting companies, and they were just too interesting and too fun to not be involved. So I literally just got started investing $1,000 per company. It's not like, I think this is one of the things that a lot of people don't understand about angel investing is you could invest, if somebody will take your money, you could invest as low as $1,000, something like that. And we could go talk about sort of like accreditation and things like that. And that's another topic that maybe is outside the purview of this discussion. But ultimately, you don't need to have just like hundreds of thousands of dollars of cash that you're looking to deploy each year. And really, you could just get started by investing just very small amounts of money. And it's great because you start to learn really fast. And ultimately, when you first start making these investments, you're like, oh, gee, like there goes the money. I'm never going to see that again. But you sort of just get to the point where you don't think about it anymore. And you're just really enjoying being involved, meeting founders, supporting them, helping them beyond actually investing. Because especially when you're getting started, if you're like me and you're investing $1,000, $2,500, this isn't really going to go very far for them. So it's really like, how can you help them beyond that? To really actually earn your spot and make it worthwhile for them to take your money. To answer your question, the first era was probably about a year and a half before the pandemic when I was doing angel investing, maybe 2 years, and I was just getting my feet, getting my footing on this, learning a little bit about how to evaluate companies, learning about sort of the place where angels can get involved. Do they need to be the first check? Can they squeeze in, at the end if there's a round that they heard about, like they heard about it too late? So I think this was a really interesting time because there were so many in-person social events and you could just meet people if you were living, and I was living in the Bay Area at the time, you could just meet people that were really interesting, that were friends of friends who were starting companies. And the opportunity to invest, if you were in the right circles and you were involved in sort of the right communities, it was just there. And it was pretty abundant. I forget who said it, but the idea is like essentially if you were living in the Bay Area and you're working in early stage startups, if you're investing money elsewhere, it's kind of silly because you have this opportunity compared to anybody else. When it comes to actually having access and to see things before they become the next big thing. So that was the first era, which for me, my first era, which was the in-person era. The next era, of course, was the pandemic. And the pandemic was really interesting for a number of reasons. But one of them was just the velocity of things actually increased really significantly. I think that everybody went into the pandemic thinking that no work was going to get done, fewer companies were going to get started, and that would just prove demonstrably false. Almost everything that happened during the pandemic was kind of went against what most people, especially in the tech industry, thought was actually going to happen. More people were starting companies. I think this was partially because they didn't have the things that kind of tied them to the companies that they were currently working at. They were no longer in the office. They were no longer feeling as closely bonded with their other teammates. There were all of these different things that kind of changed the work environment and caused people to reevaluate whether or not they actually wanted to stay at these companies anymore. So you had that fluidity of more people experimenting with and starting companies, which was obviously a huge boon to On Deck. So many people joined the On Deck Founder Fellowship because they said, you know what? I'm stuck at home. I am doing Zoom meetings with, coworkers every now and then, but I have a lot of flex time. And usually that flex time is spent doing social things at work, probably not actually getting much work done. But now when you're at home and you don't have that flex time to socialize with coworkers, I think a lot of people were taking that time and exploring starting things, be that, side projects or even, full scale startups. And, I saw more companies get started during the pandemic, in the first year of the pandemic that I saw in the past 2 years before it. And then, after that, as we're starting to move back into like maybe a post-pandemic world or a post-COVID world, what we're kind of seeing is that people are kind of rejecting the changes that are occurring within their companies again, and they don't necessarily want to go back to the workplace because maybe their lifestyle has been shifted, or if they do want to go back to the workplace, they're like, maybe I should just go back to my own workplace. Maybe I should go and start a company. So we're starting to see like this new evolution in how people are starting companies again. That's different from before the pandemic and during.
So many things I'd love to respond to. So let me just go down in no particular order. Let's start with just location, right? So you start in the SF Bay Area, and the generic of all generic tech takes is that Silicon Valley is everywhere now. Now, that's an advantage from an opportunity perspective. I got to move to Austin. I moved to New York, get to try all these different things, but that makes it a little harder, I suspect, if you are just trying to get to that real epicenter. You would know, I'm going to go to a happy hour in downtown SF. I'm going to go to this thing maybe in New York, in Soho. So how should folks really shift through that there's no center anymore bit?
Yeah, I don't necessarily know if there's no center. I think that there's just a few centers now. I think that during the pandemic, there was certainly the center was the internet, because everything had changed. Like there was no sort of in-person. Now that in-person is reemerged, there's certainly more centers than there was before the pandemic. I'm just not entirely sure how many there are. It probably depends on your definition of, what actually a center is. Ultimately, could you call Austin a center? Perhaps, or it might be a developing center, right? Miami is the same thing. I don't necessarily know if it has the strength of New York City or San Francisco. I know some people will probably be listening to this and shaking their heads at me, but I think that it will get there eventually if it's not already there. And I think that more centers will develop. But I ultimately do believe that geo hubs will always be important.
So I think the next question would be, when you're talking about that $1,000 check, right? So once again, every dollar counts, but it's not a truly game-changing amount of money, especially if you're looking at a competitive round. So when you're talking about those additional value adds beyond just the money, can you really talk about how you approached that personally? Was this really is it a commodity? Is it help? Is it specific domain knowledge? Like, help us sort through that period.
Yeah, sure. So I think there's a couple pieces. It's really about when you get involved in the round, right? Now, if you're going to invest $1,000 at the end of a highly competitive round, it's really comes down to whether or not the founder wants you to be involved at that point, right? Because they already have more than enough interest for the round. The round is pretty much done. And if they could, they can essentially fit in $1,000 no matter what, right? So at that point, it's really whether or not they want you involved. And the reasons that they might want you involved could be that you have some type of expertise. It could be that you have a certain type of network, right? There's all sorts of reasons. You could be a celebrity, right? And maybe you're not a celebrity who has tons of money, but you have tons of reach, right? So I think that that's like the if you're coming in at the end of the round. But if you're coming in at the beginning of the round, it's actually been shown that oftentimes some of the smaller checks can lead to many of the bigger checks coming into the round. Because you're going to do a $2,500 check doesn't mean that you might not introduce them to a person who ends up doing $50K. And maybe that person introduces them to somebody who does $500K. Or maybe you do $1,000, but then you introduce them to the person who ends up leading the round, right? So if you're early on in the round, what really people are looking for at the beginning of rounds is momentum, right? How could you create momentum? And momentum, in some ways, isn't really about the amount of money being raised. It's about the amount of people who committed and who committed. So if you have a good reputation amongst founders or other operators or angel investors or VCs, just because people think you're smart or people think that you have a really good, insight into a specific industry, when you invest, it doesn't matter how much you invest. I mean, it might matter if you typically are known for doing $100,000 and you only do $1,000 into this, and somehow people find out about that.
It's a negative signal.
Yeah, there could be a negative signal about that, but that really never happens, right? So what you're really looking at here is whether or not somebody is investing, and that adds an additional proof point, right? People like to talk about how investors are sheep, right? And I think that there is actual valid reason for why people look at other investors and who's investing as data points. It's important because each investor adds more data to the round that's coming together. For instance, somebody who's an LP in my small fund and is a good friend is Sander Daniels. He's one of the co-founders of Thumbtack, right? Thumbtack is for local businesses, and it's a marketplace, right? It's service businesses and it's a marketplace. Well, if Sander invests he's just an incredible investor and he's super helpful to founders. If he invests in a marketplace company, well, that tells you a lot, right? It tells you that somebody who knows a lot about marketplaces is investing in this marketplace company. And if you don't really know much about marketplaces, well, now you start to think that, okay, maybe there's a little bit more credibility around this. That's not the same thing as saying, oh, Sequoia is leading the round, so you're going to try and, just YOLO into that round. You're actually learning something when somebody like that invests in a round before you, or you share that company, you say, hey, Sander, what do you think about this company? And they really like it. So you actually learn. So I think that's really important to note. But, people like myself, like Sander, like they could really help make momentum in a round early on. And that's valuable regardless of the amount of money that's being invested.
And something I'm curious about, you had a great tweet and then a great follow-up tweet where you said right before the lockdown started in 2020, like right now is an amazing time to start a company. Once the macro conditions got worse, you said, hey, like I tweeted this then. I now think now is an even better time than ever to start a company. Can you really explain your thinking on both counts? I'd love to hear that from like a founder perspective, but then after you give your answer, we could speak about that from an angel investing perspective, right? Like, is now the best time to be an angel investor? So let's start with the founder side of things, then we'll speak about angel investors.
Sure. Well, I'll just say right now that it's definitely the best time to be an angel investor in terms of prices. But I'll start with the founder thing. The reason I said that was because there was a major shift in a lot of things, right? How people were interacting with each other, new types of problems that needed solving. And some of these problems would go away, right? So some companies raised a lot of money during the pandemic to essentially solve problems in the pandemic. And when the pandemic started to recede, obviously we still have COVID and we're going to probably have all sorts of health issues in the future and different types of pandemics. But as some of the main problems kind of receded from this first like big wave of the pandemic, those companies kind of had the tide go out on them, right? And so you had those, but for all of those that you had plenty of new opportunities that people could be building in. But also, I just think that there were more people in terms of like co-founder liquidity than I had seen in a really long time. Just looking at what we were seeing with it on deck and the types of people that were applying to the program, these were people who I wouldn't have necessarily expected to be leaving their jobs where they were, leading companies and, were executives at companies. And the reason they were leaving was because they felt like this was a unique time to start a company. And when you have those people coming onto the talent market, it means that you have the opportunity, and many of them are looking for co-founders, you have the opportunity to find and build companies with people that, seemingly, in previous years just weren't on the market. So I think it was partially a talent thing. Why is now an even better time? I think I said this in May of this year to start a company. I think it's even better because we're kind of back to a place where people can work in real life. And I'm actually a really big proponent of companies working in person, if at all possible, early on. On deck was entirely in person, as a community, as a company. We had people like David, for instance, he was traveling between a couple of countries, but like he was in person a consistent amount of time. And ultimately the in-person, I think, is just so critical for building rapport with the team, building culture, and then ultimately building great products. So, does it need to be that way? No, but almost every early stage company I see that I have a lot of confidence in these days is building in person again. So why is it a great time? It's like, well, we're back to in person. I think the other thing to consider about this is really whether or not is co-founder liquidity the main thing that you're looking for? It depends on sort of the founder.
You said it a couple of times. Could you explain what co-founder liquidity is? Like, just make it explicit.
Sure. Essentially, what does it look like out there for finding other co-founders? And I think that there is more demand than ever to find a great co-founder. And people are more open post-pandemic to starting companies with people that they've never met before and people who weren't their coworkers and things like that. And I think On Deck, honestly, is a large part responsible for this, in that we've had so many people who've met through the Founder Fellowship. Sometimes they were in different cohorts than each other, and they still met. And they ended up starting great companies. And those companies, we now have a year and a half plus data on them. And we've seen that they've done so well. So it's kind of broken that narrative, which, is that you need to have known and worked with your co-founders previously. I was watching a video as it popped up on YouTube of some old lecture. It was maybe like 10 years ago of Paul Graham talking at Stanford or something. And he said, now, whatever you do, make sure that you start a company with people that you've worked with, for a long time, that you have a really long relationship with. And I was like, man, this is an artifact of the past, right? Now, obviously, if you know somebody that you could start a company with and you have a great relationship with them, and you've sort of like proven that you could work well together, by all means. But that really restricts the amount of people who could start companies. And we've seen since the pandemic that there's just so many more people that you could meet. And even YC has a co-founder matching tool now. On Deck does co-founder matching as well, but YC has one too, which just goes to show that we now realize that co-founders can be found anywhere. And that creates a really big opportunity.
See, it's interesting to speak up for Paul Graham, who doesn't need me to speak up for him, of course, because he's Paul Graham. One could say that obviously if you've known someone, if you've worked with someone, there are all sorts of red flags, green flags, thing one would just know from it. Like, what lessons have you learned from your time at On Deck about how do you actually take it beyond, oh, Julian, for example, you were, I've told this to someone, you were an amazing executive producer of The Deep End. Seriously, you were a great booker. You had great show ideas, like great things. We know those surface level details, but there's still something deeper than that, maybe, that would make us like, hey, like, let's start a podcasting company together. Like, what would be those second level details beyond just virtually interacting that you've really learned from like On Deck about helping founders actually work well together?
Sure. I think that it's really alignment on these very important core values. If you look at the best co-founders, they tend to really believe in sort of the cultural stuff first, right? For instance, do we work in an office together, and is this an in-person company to start, right? How do we think about sort of, work hard and also have a work-life balance, right? Like these people who are evaluating starting companies together, they really need to align on these fundamental things. What happens if just various sort of permutations, right? What happens if something goes wrong, right? Like, or the market ends up not liking our product? Like, what do we do, right? And I think that it's good to sort of front load a lot of these conversations. It's tired, the analogy to dating and relationships, but I think that generally speaking, a lot of this applies, right? The more that you're going into a conversation with somebody and really having these like harder conversations earlier around what is a meaningful outcome for you, right? Like some people might want to sell the company, when it's worth, $40 million, and, the founders have a significant stake in the company still, right? Others, the other co-founder might want to sell it $4 billion or $40 billion or take the company public, right? And aligning on that stuff, I think, is just essential.
I'm Laura Thompson, the founder of Execs on Deck, a community of top leaders who want to build big careers in startups. A lot of people know On Deck as synonymous with top founder talent, but we're creating a community of mentors, advisors, and critical leadership hires with 12 plus years of experience. I started this program because when I made the leap from Google to joining a startup in a leadership role, I found there was nowhere I could turn to access an experienced peer network wanting to have the same kind of impact. If this resonates with you, the second cohort of Execs on Deck kicks off October 18th. Head to beondeck.com/execs to learn more.
I think the next question would be taking this then to the best time for angel investing? It seems like if you're going past basically when the country started to quote unquote reopen. So once you get into June, July, August 2020, there was just so much energy to angel investing. It was super cool. Everyone's tweeting about it. It's in the bio. That would seem to be like peak hype cycle bit of it. Like, how would you think about like the narrative side of this and actually balancing that with like, hey, like if you're in tech, this is a logical place to invest real amounts of money?
Sure. So, I think there's different types of angel investors and different like levels of angel investing in terms of levels of commitment to it, why people do it, sort of how people angel invest, that sort of thing. And I think that really drives kind of the behavior in a lot of ways, and also the behavior in this new market, or this new sort of shift that we're seeing. Ultimately, when everything is going crazy, the valuations are going up, like all of this stuff causes people to want to get involved, right? It's the same thing with crypto, right? There's this very famous meme or whatever where it's like, people are like, oh, like, Ethereum is now much cheaper, but like you wanted to buy it back when it cost twice the price and now you don't want to buy it, right? It's one of those things where when everything is just looking really, really good, and there aren't many challenges, I think that people are generally just more likely to jump in. But I don't think necessarily everybody's going to stay in the water once things get a little turbulent. So I think that's the first thing. The second thing is really just around, like why are people doing it? Like, do they have a long-term goal? Is this, and the way that I think about it here is, there's two types of founders. There's sort of like the insiders and the outsiders. These are the two types of founders as I like to describe them when I invest in them. The insiders are ones who just have like a track record, and that might be, having significant operating experience at, a rapidly growing company. It could be that they've started companies previously. Either they went super well, or they might have flamed out, but they put in a really good effort. And you can just tell that, they're hungry and they want to go and build a new one, and they're going to do an even more ambitious, company this time. And then there's the outsiders. And these are people who I would describe as like generally illegible to a lot of investors early on. And essentially what happened during the pandemic, when there was just so much froth and so much excitement, was that the insiders, when they went out to raise, it was just extremely expensive, right? You were looking at, 50 million post-money valuation for a seed round, right? Sometimes much higher, right? And then when it was the outsiders, even the outsiders, just because there was so much interest, a lot of outsiders were raising at what I would describe as like inflated terms as well, right? So ultimately, and the reason you have to think about returns is really just like how much, like what's the probability that this is actually going to how big can this get? And therefore, like, what is the multiple on this? And then looking at this across, the range of investments that you're making, like, can one investment just return, almost all of your investments? If all of them go to zero and this one does extremely well, is that going to be good? And I think that valuation inflation was just across the board, and it was especially severe for those insiders. Now things have sort of come down to earth. And the insiders, they're still going to be more expensive in terms of the price, but I think that they're actually much, much fairer now. They might even be going down slightly from here, but on average, like I think that it's a better entry point in terms of the price for angel investors and for VCs for that matter. And then ultimately, the outsiders actually need more help than ever. And you actually have a really big opportunity to invest at extremely favorable valuations, but that are also still fair for the outsiders. And then you can actually really help them gain that momentum. The thing that I really think about, with angels is that momentum capital side of things.
And something I'm curious about, you've spoken about how in this current bearish moment, we're seeing just like an insane amount of like just grit, and just like trying to find I need to find the exact wording here, but we're seeing a level of drive from founders that's really unparalleled. Can you talk about, if you're an angel investor, like what traits are you looking at when you're evaluating a founder, if you're evaluating a company? Like, how are you thinking about that? Because I'd imagine drive could be one, but I'm sure people often have drive. So it's hard to really sort of sort through that.
Yeah, I'm going to kind of give a cop-out answer here. So continue to push me if you'd like, but let me start by saying that I'm very market focused, not like sort of the economic market, but more like the market that a founder is building in. I just think that it's one of the most important things, because if you are extremely driven, it doesn't matter if the market sucks. Right? If the market sucks, you're just going to be driven and you're going to drive yourself into a wall that just is not going to go anywhere, right? Nobody wants the product, or it's just like fundamentally at odds with sort of the needs of the market. And to me, that's just a kind of tragic, right? Because if somebody is driven, intelligent, really wants to go and build something great, like go find a market that you could go and that really needs help, or really needs a product or a service. And then ultimately I sort of work backwards from there, right? I look at some of the best founders, and this is not to say that like these are the only good founders. These are just some like really excellent founders. And you look at them and they're very particular about the markets that they build in. I think of my friend Ryan Delk, who's building Primer, which is essentially both micro schools and sort of online communities for young children who want to embrace their curiosity, learn and grow in a way that they're just not being serviced right now by sort of the traditional options. And homeschooling is growing rapidly, right? But ultimately, this isn't even just homeschooling. These are micro schools, right? Homeschooling is limited by the amount of people that could actually, one, have the time to take care of their kids. School is in some ways daycare, right? In the sense that like there needs to be childcare, and you need to have people watching your kids while you're at work and whatnot, especially if you don't work from home. And it's like he's not only going to be expanding this market for micro schools, but he's also going to be, serving all these people who are already doing homeschooling, and just giving them a much better experience and helping their kids. And that's just like a really great market opportunity. And, he's not the type of person who would choose a bad market opportunity, but there are a lot of people who probably have the same amount of potential as him, but just haven't been necessarily in sort of the tech ecosystem long enough to realize that the market really matters.
Yeah. And speaking of markets, I'd love to hear just broadly, what are some spaces that you're really excited about right now and have been excited about like going on into this period?
Okay. So you're gonna probably hate this answer too. Well, I don't know if you hated the last one.
No, that was a good answer. So you're on safe ground.
So this answer is I really don't know what it's not an actual door, but like I don't know who's gonna walk in the door and what they're gonna present me with next. So I try not to actually say like, I'm really excited about this space or this opportunity. I think some people are very thesis driven. I really am very open-minded, and I say, is this a future that I want to vote for? And if it's really compelling, then I want to do it, right? And I want to be involved, and I want to help the founder make that happen to whatever extent I can be helpful. But ultimately, I don't really think about like, oh yeah, I've been waiting for this company to come along. I mean, I guess there's occasionally stuff like that happens, but for the most part, it's really just waiting to see. And then when I see something that's amazing, I'm just really excited about it. I'd rather have that open-mindedness versus being like, oh no, I'm only looking for this particular thing. And, occasionally it's I'm actually discovering it. I'm seeing a founder out there. I'm seeing a product out there in the wild, and I'm going out and I'm finding an intro to that person. I'm not just waiting for people to come and talk to me, but ultimately I'm just sort of seeing what's out there. And when I see something that I'm really excited about, that's when I get involved.
Okay, so I didn't hate that answer because you gave a good answer in terms of getting us in your head how you're evaluating things. I'm more curious intellectually. So for example, I'm very intellectually interested in like the American dynamism space.
Sure.
Doesn't mean I'm like pouring money into it, but I think it's an interesting like framework for evaluating a set of problems in the world. What's something that's intellectually interesting to you? If you're curious, but maybe it's Web3, maybe it's, once again, you're talking about homeschooling, like that's a response to kind of like the COVID era schooling thing. Like what's something like that?
Sure. I think so just to speak to American dynamism, Traba is a really good example, right? They are based in Miami. They're one of those companies that not only said, we're going to be in person and we're going to not have much of a work-life balance. It's going to be a work balance. There's going to be two sides to the scale, and it's going to be work. And ultimately that drives a certain type of person to the company. And that ultimately means that they're going to have, the type of work ethic that makes sense for them. And people who don't like that should go and work other places. Like, I don't really understand the controversy around being very open with who you are and what you care about, and then letting people go and decide to go and work at a different type of company with a different type of culture. Putting that aside, I think that it's really interesting to think about what are things that are recession-proof businesses? What are things that actually, if a recession happens, become even more valuable, right? And then, after the recession recedes, can they still have a really important place in society? And I look at Traba and I think about that. I look at things like, you had me on your other podcast to talk about Constitution DAO. Constitution DAO is very interesting, right? It was kind of this, I think, a watershed moment for Web3, thinking about things that are beyond sort of speculation in crypto. And ultimately, I look at what Archive is doing, which is a DAO dedicated to creating a decentralized Smithsonian museum. And I think, wow, that is really something that's special. And if it's successful, it means that people have really changed their relationship with art, culture, even themselves. Because I think that museums have this really important aspect of, you're not just looking at things, you're looking at yourself when you through the objects that you're observing and the things that you're learning.
So I think two related but unrelated questions. So the first one would be, I liked your kind of picture of an angel investor in, let's say, June 2020. When you're thinking of on-deck angels and just the space right now, can you just give me an archetype? I guess you said there are different types of angel investors. Like, what are a couple archetypes of folks who either are or could be angel investing who would be listening to this podcast, and you're kind of looking to find a moment of resonance with them? Would love to hear that.
Sure. I think, there's a few people probably who are going to be listening to this who say, I've done a few angel investments and I kind of have done them sort of haphazardly. Like, I'm really happy about them, but I also realize that I probably, if I want to really have a go at this and do angel investing, I should probably both pick up the momentum and sort of the velocity of investing. And also, I should probably not just do it in a silo, right? Because typically the way it goes is somebody, who hasn't really done much angel investing yet, or maybe has just gotten started with it, they're kind of investing when they hear about something that a friend is doing, which I wholly support. You should almost always invest in friends. It's just one of those things where it's just such a good thing to do. Can I ask an awkward question beyond the obvious? Like, when should one not invest in, beyond just the obvious? Like, I know he's a criminal, or I know she's like about to. Well, I don't have too many criminal friends, thankfully. But I think it really comes down to, like, is this actually something that, like, are they building a venture company? Like, are they saying, hey, like, I'm just looking for people to, like, back my, like, YouTube project or something? Like, I don't know. Like, I still think it's probably worth supporting them. I wouldn't necessarily look at it as an investment, but I would look at it as, like, helping a friend, and supporting them and sort of their passion or their talent. Generally speaking, I'm like highly biased towards supporting friends, in whatever it is that they do. Because, I hope that, they would want to support me in what I do, not even necessarily monetarily, just like spiritually. And I think that really matters. Because, like, what are friends for other than to support you, both in, the challenging times, but also in sort of like the beginnings of what might be to come.
Sorry, I want to talk about this for a second more, because once again, if we're thinking of prospective angel investor types, one could just think of the almost like cliched, but also sometimes actually good advice that you shouldn't go into business with friends and family. So how could you talk about the monetary relationship or that dynamic? Like, when you are, because once again, like, one shouldn't just dismiss friends, because obviously, like, that's your closest network. That's where you're going to hear about deals. That's just basic math. Like, how should one think about monetary aspects of relationships?
Yeah, I think monetary. So, this is a broader topic than just angel investing, right? I think that the main thing is, like, if it becomes like such a large amount of money that you feel like there is like there's an actual stress there where it's like, if you loan a ton of money to a friend and expect to receive that money back, then if you don't get it back, or if something bad happens, you might be kind of annoyed with them, or they might feel awkward about it. And I think this is like, invest amounts that you're comfortable losing, right? Like entirely. And if it's a friend, you should actually be happier about losing the money than if it's just some random stranger, right? Because ultimately, if it's a friend, you're like, oh, well, I did a good thing for my friend and it didn't work out, but ultimately that was great. Like I'm so happy that they got a chance to do it, right? They got a chance to try and build their dream. So I think that generally speaking, it's actually easier investing in friends in a way, because there's like this aspect of it that is more personal. But I mean, like most investments I do are not necessarily in friends, they're just in founders that I happen to meet. But yeah, I mean, I invest in a lot of great people that are friends or former coworkers as well.
Yes, we were talking about archetypes basically. So one archetype was, just doing it, but like a lack of like momentum in those bits. Like, what are some other examples of folks who should be looking into taking this at a more stepped up level?
Yeah, so I think that those people, like on average, are like, some people are just fine with doing the occasional thing, but I think a lot of them are kind of looking at their investments or like at the startup ecosystem and saying, well, what if, right? What if I started investing more? Like, should I actually be trying to help founders more? Should I just be like in the game a little bit more? Because I think it's like, it's really fun, right? It's fun. It's, it certainly like has the potential to be a very like smart, like monetary decision. And ultimately, I think that people are just, the reason that they're not getting in the game is similar to the founder stuff, right? Why aren't founders actually sort of getting off the fence and like building companies? Well, oftentimes it's like, well, I don't know anybody to start a company with. Well, On Deck solved that, right? We have cohorts of people that are looking to start companies, and a lot of them are looking to start a company and they might want to start it with you, right? They're like, well, I don't really feel like I have sort of the right way to like discover the idea. Well, On Deck creates like a cohort around, making it so that people can go through the idea maze together. They can sort of like work on different ideas, that sort of thing. And I think the same thing is true for angel investors. It's like, well, I don't really meet that many founders in my day-to-day life. So it's like, how could I really get more involved in angel investing? Well, the way you do that is by being involved in a community of other angels, right? And other angels will be introducing you to the founders that they're investing in or the companies that they hear about, right? And you're going to be doing that for them. And not only that, but you might say to yourself, well, how do I know if I should invest in this company? Well, you're going to talk through that with other angels as well, right? And I think that's the most important thing is I think that like there's this belief, founders have this belief that like investors don't talk, and like that's just generally not true at all. Investors talk all the time, and investors, I think the ones who treat founders badly, they also think that founders don't talk.
And to clarify, you mean by people assuming they don't talk because they're competing with one another, like in that sense, or what? Yeah.
Yeah, okay. I mean, it's like competing or like, they're trying to like have conviction on their own. And ultimately it's like, no, like oftentimes, you want to get feedback from, because I was giving that example earlier about how, if a certain investor is backing a company, like that gives you data around the company and around, why this type of person is investing. Well, it probably means that they feel like this is a pretty good marketplace company, for instance. So ultimately, I think that, creating that community and people that you can learn from and sort of like actually riff on opportunities with is super important. Again, it's not about the herd mentality. It's just about like being able to learn and sort of develop that muscle, right? I think that it's a lot easier to go in with conviction on making an investment if it's your 50th investment, right? You've had so much more knowledge and data accumulated. The other thing that's worth noting is, I describe investor updates as like the best paid newsletters, right? And the reason for that is because think about, I've invested in like 100 plus odd companies, right? Sometimes just $1,000, but at this point, to have a small fund, more than that. And I get all these newsletters every month or every quarter. And, I learned so much from reading these updates. I call them newsletters, but they're updates, right? And it's so valuable, and you learn so much about how founders think, how they articulate their vision, how they share problems, how they share asks. And, I reply to almost all of them. I try my best to, and I try to help when I can. But sometimes all a founder needs on an update is like, we don't have any asks, but here's what's going on. And I like to reply just to show them that I read it, because not everybody does, which is sad. But I think ultimately it's like you could do all of this with a community. You could do this where you're learning together, you're discovering opportunities together, and then ultimately you're developing that muscle. And I don't think you can develop that muscle by going to the gym once every couple of months, right? Like, you really need to create a sort of a habit and a routine around it, where it's just like strength and conditioning. You can't just do it once every couple of months. I feel like you really need to have more velocity than that.
I'd love to just close with just a pretty straightforward pitch for, ODA, next steps, folks who are really interested and captured by it, even in this current moment. Just would love to hear that and close there.
Sure. Yeah. I mean, I think that, so ODA is the reason that we built ODA is because we think, similar to Founders, as I was just saying, there is a lot of value in creating a space to sort of find the missing pieces for people who have done some angel investing, or maybe they're just getting started, but who really want to go and like start to increase the velocity there, increase the learning, and develop the muscle, right? It's a thing that you really cannot do in isolation. Investing is like the most social sort of sport or activity that there is. And ultimately, the way that you get good at it is repetition and by being around other great people. And that's why we created ODA. And we've been at it, for many cohorts now. We're going to be launching the 8th cohort very soon. And it's just such an incredible thing to see these people who started out maybe doing a few investments, launching syndicates, launching funds, launching rolling funds, and really just co-investing together, developing an eye and sort of a way of thinking about how to evaluate companies and talk to founders. And I think that's just a very special thing that we're not seeing much of out there. And, that's why I'm super excited to be, a part of it. I'm spending half my time with founders in the OnDeck Founder Fellowship, and then half my time working with ODA. And I really like to be that bridge between those two communities, because there's so many great founders that you can invest in the OnDeck community. About 800 companies have been started, and they've raised $1 billion over the last, 3.5 years since we launched the Founder Fellowship. So the real reason that we're doing ODA is to help people develop that muscle, and then also be that bridge to capital, and help those founders create that momentum. And I think there's a huge opportunity, an economic opportunity and an experiential opportunity to be an angel who's involved in all of that.
I think that's really well said. Julian, this has been really great. Do you have anywhere you want to throw listeners to, any writing, any other tweets that we could mention?
Sure. I mean, I'd say I'll put together a list and we can have it in the show notes.
Okay, great.
My name on Twitter is just Julian Weisser. So that's like a good jumping off point to all of the other links and things like that. But yeah, I'll put together a list of things for readers in the show notes.
Awesome. Julian, thank you for joining us in the deep end.
Thanks for having me. It's really great to be here again.